So, how do analysts use trading ranges? Getting back to our earlier introduction of sideways trend, trading range, as shown in the figure 4.9, is a price level where both support and resistance zones are relatively close together, and prices bounce between them until finally breaking out in one or other direction. Some traders will trade the bounces between support and resistance, but this is usually dangerous and requires low operating cost and constant attention, as per Schwager 1996. The most profitable and reliable way to use the trading ranges is to practice breakout trading. Let us look at each of these strategies a little more closely. First, let's begin with range trading. Trading with range is difficult, although many books suggest it is a strategy. It is almost impossible for the non-professional to profit through range trading. First, it is difficult to recognize that prices are trading in a range until after a considerable amount of trading, when time has passed. It is therefore largely in retrospect that the opportunities are recognized. In addition, operating costs such as commissions and slippage must be small and execution efficient, or else any potential profit will be overwhelmed by transactions cost. Because the bounds of a trading range are often zones rather than specific price levels, the point at which an execution order, either buy or sell, should be placed is indefinite. Finally, the location for a protective stop loss order to prevent a breakout through ruining trade profit is difficult to determine. By the time all these costs and the execution levels are recognized, the potential for profit has diminished considerably, making any profit versus risk unlikely. Thus, most traders stay away from trading within a range or a trading range, and instead wait for the inevitable breakout and beginning of a trend. The one exception to range trading is channel trading. A channel is a trading range tipped at an angle such that it trends upward and downward. Trade lines define the bounds of channel, just as support and resistance lines define the trading range. One can trade these channels back and forth, but only in the direction of the channel trend. In other words, if the channel is trending upward, only long positions are taken at the lower bounds and sold at the upper bounds, but no short position is taken contrary to the channel trend. As mentioned earlier, upward trends have longer upward subtrends and shorter downward subtrends. To a certain extent, depending on the slope of the channel trend, the subtrends in the direction of the trend reduce difficulty seen in the trading ranges. Next, we will go through breakout trading. Breakout trading is as old as technical analysis and likely the most successful. Remember that a trading range is somewhat like a battleground where the buyers and sellers are waiting for dominance. Most chart patterns are a combination of trend lines, and thus are battlegrounds also. Before the battle is over, it is almost impossible to determine who will win. It is usually wiser and more profitable to wait rather than to guess. Once, however, prices break out of the trading range, the investor has information about who has won the war. If the breakout is to be upside, buyers are driving prices up. If the breakout occurs to be going downside, sellers are overwhelming buyers. Trading on this breakout is probably the most profitable and reliable strategy for the investors faced with a trading range or pattern. One of the famous is the Donchen breakout method, also called the 4-week breakout method, organized by Richard Donchen and later improved upon by Richard Dennis. It still appears to work. A recent study by Active Trader magazine, Guzik and Knapp, indicates that even though the method is popular and has been widely known for many years, it still produces profits, especially in the commodities futures market. Its calculation is absurdly simple. When the highest high over the past 4 weeks is broken, Sell when the lowest low for over the past 4 weeks is broken. Breakout is a powerful signal, by the way. It indicates that the balance between demand and supply has been settled and shifted, usually violently, and thus is an indication of the intention or a continuation of a directional trend. Next we will go through directional trends. We will take a break for today. Thank you.